More house price declines in May, continued interest rate hikes coming up, and red hot inflation numbers still. What does all this mean for housing? Also, we had an appeal for garden suites in Toronto, as well as updated policies for garden suites in Hamilton. That's going to make things a lot easier. Stick around as we cover this and more. Okay, welcome back. This is Andy from Sweet Additions, where we help homeowners and investors create better homes and generate lasting wealth. Please take a second to like this video and subscribe to this channel if you haven't done so already. It really helps us out. All right. So it looks like there are continued house price declines in the GTA from its peak in February. The average price of a home in GTA in May was $1.21 million, which was a decline of 3.3% from April and a 9.1% decline from the February peak, which is roughly a drop of $110,000 for the average home in a matter of 3 months, okay? However, we still have a year-over-year gain of 9.4% from May of 2021, where the average prices were approximately $1.11 million. The number of active listings are flat compared with April. However, the number of listings compared with May of last year are up 26% year over year. Just over 7,200 homes were sold in the GTA in May, which is actually a yearly decline of close to 39%, while it was a decline of 9% compared with April. So based on these numbers, it appears that there's the dynamic that despite more listings with fewer sales, sellers are perhaps reluctant to sell at the price that they want to get their property for. You'll notice that there are many listings that are either terminated or suspended when you go on MLS. I think we're in a stage where a lot of people are now nervous about the market given the tightening that we're seeing from the Central Bank of Canada. However, I think that there are still a large segment of sellers that will need to sell because they need the funds on a property that they purchased a couple of months ago. Okay, so this is the danger of buying a house before selling your old house. I'm talking about the principal residence here. When you don't have a lot of equity in that property, okay, so they may be forced to sell at a discount. So what does this all mean for housing going forward? What can we expect? Of course, this is all on the backdrop of rising interest rates. The Bank of Canada once again raised its overnight lending rate by 50 basis points on June 1st, or 0.5%, and it's now sitting at 1.5%. Now, word on the street is that they would like to double that to 3% by the end of the calendar year, or potentially even higher. Of course, this is to tackle the persistent inflation that we're seeing. You can see in this article that the Bank of Canada is saying rates may need to double to fend off what they're calling galloping inflation. Okay, that's the first time I've heard that term, galloping inflation. It's clear that inflation is no longer transitory. The next central bank meeting is July. Many people are expecting another 0.5% or even 0.75% increase. Given how bad the market is reacting at this time, even at 1.5%, doubling the interest rate would definitely put things over the edge when it comes to pushing us into a recession. And of course, I think that that's going to happen. In this article in the International Business Times, the Bank of Canada Governor Tiff Macklem made it clear that they will need to keep increasing rates until they're able to get their 2% target inflation. So what they're saying is that they're hoping to get rid of excess demand without overcooling the economy. So this is a very tight rope that they're walking here. They think that they'll be able to bring control to prices without damaging the economy too much. Okay, I'm going to share my thoughts on that shortly. So let's dive a little bit deeper into inflation. In Canada, our inflation numbers were 6.8% in April. That was 2 months ago. So our data is a little bit, there's a little bit of a lag, whereas in the US, I think the June numbers already came out. We'll share that in a second. So in the US last week, the official inflation numbers clocked in at 8.6%, the highest since 1981. Okay, so those inflations came in last week. I think I think the market was expecting 8.3, and then it came in at 8.6. And then we'll talk about what they did after with the rate hikes. But let's just kind of stick with inflation for a second and look at some of these items, individual items, and let's look at some charts. So in this article from smartestdollar.com, talks about individual products and services most impacted by inflation. So let's stop here for a second and look at this chart here. Consumer prices increasing at the fastest rate since 40 years. So here we are right now on the far right there. I guess 2022. The last time it was this high was back in the early 80s, probably 1981, 1982. And you can see it was even higher around 1980. Now, keep in mind is that the metrics that we used back in the early 80s is different from the metrics we use now due to hedonic adjustments. I've talked about that in the past. If you use the same metrics, it's probably even higher. Like a lot of people say that if you use the same metrics, they run the calculations. There's a guy on the internet called John Williams, and he does all these really cool charts to kind of compare historical inflation. And he says that we're probably closer to 15-20%. And I think we feel that in a lot of places, especially when it comes to food, energy, housing, etc. Right? So let's look at some individual items. When you look at overall all items, it's around, I guess, 8.6%. Food, around there. Energy, way up, almost 30%. All the other items minus food and energy is probably 6 or 7%. So their target is 2%. Let's look at some products here, products and services. Fish and seafood, 10%. Coffee, 10%. Fresh fruits, eggs, all are hovering around 10%. I mean, those are all things we need, right? New vehicles, 12%. Poultry, 12%. Pork, 14%. And then cars and car-related items, motor vehicle parts and equipment, 14%. Meat has gone up substantially. And then energy, gas services, up 23%. Car and truck rental, I noticed that recently, renting cars, it's gone up quite a bit, as well as hotels and vacation property. Okay, so excuse me, I'm just checking some information here. Okay, so you probably heard the big news on Wednesday that the Federal Reserve raised rates by 75 basis points or 0.75%. This caused stocks to tumble the last couple of days pretty substantially. And it looks like they will continue to be pretty aggressive in the next little while to bring inflation under control. But the term aggressive is relative. Okay, so in 1981, rates went close to 20% to tackle inflation, but here we are arguing about having 0.5% or 0.75%. Excuse me. So why is that? Well, the debt to GDP ratio in Canada and the US are over 100%, which is not sustainable. And if they raise rates too high, they'll actually cause the economy to fully unwind and essentially implode. I don't think they're going to let that happen. So what's likely to happen? Well, it seems pretty clear that the central banks are essentially trying to engineer a recession. This is actually a little bit of a surprise to me. I didn't think that they would push for it this hard, but I think the political pressure as a result of the high inflation we're seeing is just too strong. They're now trying to fix the problem that they caused in the first place, which is the extremely loose monetary policy that was started 2 years ago, and even way before that. I mean, this started back in the financial crisis of 08, 09, and sort of saying that they're just going to keep credit loose, keep interest rates low to keep driving the economy. That was the time when things actually probably should have been tightened, and then the system got a chance to reset itself, but it didn't, right? So really, they're between a rock and a hard place now. You're either high inflation or recession. Pick your poison. It seems that right now they're not concerned about individuals, households, and companies seeing their assets, such as stocks and real estate, decline. However, this will probably be an issue when those entities are struggling so much that they won't have the revenue to service the taxes that are needed for the various government deficit spending, and eventually, those entities will go bankrupt, right? Ultimately, the central bank is a source of financing of last resort, which means they print more money. Okay, I think it's worth a reminder of the massive amounts of debt that are, not only on the private level, but on the public level as well. I love looking at this debt clock here. The recent actions taken by the Central Bank of Canada, as well as the discussion for what's to come, shows that they're entirely fine with engineering a recession that will significantly impact the private sector in the name of trying to bring down inflation. Okay, so this is households and businesses. However, the government also relies on the private sector for tax revenue. So if certain businesses fail, then that will affect the bottom line that is needed to service the public debt. Okay, so think about if the housing sector goes through a significant downturn. Many homeowners will not be spending money on all the services and products associated with housing. So these include renovations, furniture, landscaping, other products and services associated with owning a home, and many non-tangibles as well, such as legal services, realtor fees, moving expenses, and the list goes on. So ultimately, when the pain is bad enough, I believe that they will reverse course as soon as inflation peaks and goes back the other way. Now, keep in mind that even if inflation is at 0%, it doesn't mean that things get cheaper. It just means that it doesn't continue to go up at the rate that it has been, okay? So even at zero inflation, gas is still going to be north of $2 a liter. Now, it's important to once again remember that Canada is just a very small player in what's going on. Pay attention to what the US Federal Reserve is doing and what their debt levels are like, because that's where the rest of the Western countries follow, which is why I love looking at this particular debt clock from the US. Okay, so their net debt keeps going up. Right now, their US national debt is 30.5 trillion. There's no way really for it to reverse course, right? Anything short of a miracle economic growth, it's just impossible for us to kind of pay down this debt. I mean, it wasn't that long ago when I think it was 30 trillion. The number that I like looking at is this one on the bottom right here, U.S. unfunded liabilities. So this is all the this is what's needed to pay Social Security. So retired folks, the upcoming baby boomer population, Medicare, those things, and they can't just not pay, right? They can't just default. So likely, what's going to happen is they're just going to devalue the currency so that they can pay them in currency that's less valuable. So the net debt keeps going up, and there's no way for it to reverse course. So long-term game, I believe, will be more money printing. Okay. All right. So let's take it back to real estate. What does this mean for real estate going forward? At the end of the day, I personally feel that this is a blip in the long-term inflationary environment. Some people call that financial repression. This is going to be very volatile. Okay, and depending on how you position yourself, you might be able to take advantage of it. It's going to be very hard to time exactly. If you're not over leveraged, then you might be able to snatch up a property in the next few months while we're still in this tightening environment, right? In most markets, there's a 10% decline from the peak of February, while even up to 30% in some markets as well. I've heard some of the higher, more expensive markets like in the GTA, Markham, Richmond Hill, Oakville, some places have gone down 20-30%. Of course, this is not investment advice. Please do your own due diligence and figure out what works best for your specific circumstances. I'm personally planning on buying the dip this summer if possible, and hopefully acquire a couple of properties at discounts and applying the forced appreciation strategies I keep talking about: cosmetic improvements, second suites, garden suites, etc. Additionally, I'm hoping there will be more inventory for me to choose from where I can apply those densification strategies that I mentioned, okay? So this segues us nicely into the next topic, which is policies around garden suites in Toronto and Hamilton, two of my favorite cities in Ontario for housing densification. It'll be great if I can purchase one property in each of these cities this year. Okay, so let's switch gears and talk a little bit about that, garden suites in Toronto. Okay, so what's new with garden suites in Toronto? So for those of you who are not familiar with the current situation, garden suites as third units they were approved in Toronto back in February, but a bunch of resident associations in Toronto got together, formed a coalition, basically a bunch of NIMBYs, filed an appeal to push back against garden suites in Toronto. So what this means is that they're taking this to the Ontario Land Tribunal, the OLT for short, and to seek an appeal to try to eliminate these garden suites from being built in their neighborhoods. Now, instead of pushing against garden suites as being not an ideal solution, because they couldn't really come up with anything negative to say about it, other than to make claim that they will ruin their single family neighborhood, which they know won't hold much water in this housing crisis. Instead, they used a technicality saying that there should be more specifics around building these in the backyards of multi-unit buildings, which is entirely irrelevant. There was an initial meeting back on June 3rd at the Ontario Land Tribunal to determine if this needed to go to an official hearing, which could take months or even up to a year down the road, or if it will get thrown out. I wasn't able to attend this hearing because I was at another client minor variance hearing, but here's some feedback from other practitioners in the space. So the good folks over at Lanescape, in their newsletter, they said, during the hearing, the second paragraph here, during the hearing, the city worked tirelessly to advocate for garden suites while the resident associations had very little to say in opposition. The Ontario Land Tribunal will be reviewing all information presented at the hearing and will be publishing a decision in the coming weeks and months. Sean Galbraith, a prominent Toronto planner, he's a private planner. He stated in this Facebook comment, the OLT has the option of issuing an oral decision ahead of the written one. They chose not to do so and will issue just a written decision when it's available. Could take anywhere from a week to a year. So that doesn't help us out right now. Hopefully it's closer to a week. Only issue at hand will be should a full hearing happen or the appeal dismissed. Based on the presentation by the city and the NIMBY lawyer, this should be violently thrown out. Interesting use of words. Okay, so let's hope this gets wrapped up soon and we can get to work building these. I already have clients, including seniors, who want to build these and they want to move in and rent out their main house to their grown kids. Okay, now shifting over to Hamilton, there was a planning committee meeting on May 31st, and it looks like some big news as well with their garden suite policy. You can actually see the document. First off, they will be changing the name of secondary dwelling unit, SDUs, to additional dwelling units, ADUs, which is the proper acronym, although ADU typically stands for accessory dwelling unit, okay, but that's fine. ADUs is fine. It sounds a little better than SDUs. There's some confusion. That's not the big news. There are a number of changes. I won't go over all of them right now. You can check it out in the link below that takes you to the bylaw document. By the way, all the links to everything I've shown is in the description below, so you can check it out and read more for yourself. Okay, so the big change will be that any house that existed prior to May 2021, there will be no additional parking requirements for any of the new units, okay? You'll still typically require 2 parking spaces for the original home, but you won't be required to provide any parking for any of the new units. This is definitely big news because so many obstacles we come across are a result of parking challenges. Sometimes this has a ripple effect on other items as well, such as driveway widenings and forestry issues. So this is great news. It's not fully passed yet, just needs some time to be ratified, but you can check out the rules in the article so that you can learn more for your own property or if you're looking to buy property in Hamilton. All right, so the very last thing I'm gonna touch on briefly is the provincial election, okay? I'm not gonna go over in detail. So it seems like the PC party went on to easily win a majority election. Now there's a lot of things on their platform that I'm definitely not a big fan of, including expansion of highways and potentially expansion of urban boundaries for the purpose of single family zoning, even though this is more profitable for developers, which I consider myself to be one. I'm totally fine with someone who wants to build a single family home on a lot they purchase. They can do whatever they want with the lot, but to create new development sites which forbid multi-unit homes on the lots, I think it's going backwards given everything we know about city finances and as well as the damaging effects of urban sprawl long term. However, overall, I believe that the PC party is the one that's going to be more capable in building more housing. Again, they want to build 1.5 million homes in the next 10 years. I don't think they're going to be able to do that. That target is going to be really hard. That's double the amount of housing that's being built right now. But in the Housing Affordability Task Force report, which they instituted, there were a lot of recommendations for more housing options. Now, we know that the recent Bill 109 that was passed, I think in April, March or April, the More Homes for Everyone Act, it was a bit watered down for political reasons due to the election. But right now, since they're back in power, I believe they will continue to push for more densification in existing single-family neighborhoods. Expect that we might be able to build 3 or 4 units on existing lots as of right. Okay, so stay tuned for more information on that. We'll be sharing more as more information is available. Okay, so that's all I have for you guys for this month's roundup. I really appreciate you watching till the end. Again, if you don't mind liking and subscribing to this channel, if you haven't done so already, it really helps us expand the channel, get more information to people so that they themselves can create more housing, generate wealth as well. And yeah, I really appreciate you guys watching this till the end, and we'll keep it going. We'll see you in the next video. Thanks a lot. Take care.